Hi everybody, this is James Tompkins and welcome to Lecture 9 of the International Finance Series. And by the way, this is really part 2 of what is often termed as exchange rate parity conditions. In Lecture 8 we talked about the inflation model and let me stress it is a whole lot more easier, it will be a whole lot more easier to understand this lecture if you've already gone through Lecture 8. So I strongly encourage you listening to Lecture 8 first if you haven't already done so. So in any case, why are we doing what we're doing? Well, basically the theme of this class is international financial principles as it affects firm value, and value is a function of risk and return. And the element of risk that we're looking at that you might relate, say, to international stuff, exchange rate risk. So the goal in the first half of this class has been to gain a solid, not memorization, but understanding of why, for example, the dollar goes up and down in value. And the second half will look at managing that risk and not just managing it, but taking advantage of risk opportunities that exist out there. So in any case, what we're doing today is yet another cog in the wheel, if you will, of understanding why it is that the dollar goes up and down in value. And we're going to look at the role of interest rates. So let me begin with an agenda, and I'll start off with maybe putting today's lecture in perspective as it relates to the inflation model, and then we'll actually get into the interest rate model. Talk about interest rate parity, which is analogous in Lecture 8 to the law of one price. We'll look at the international effect, which is analogous to, from Lecture 8, of purchasing power parity, and I'll remind you of that in a minute. And then I've told you how conceptually the inflation model and this model are identical, but we'll also show it mathematically. So as an introduction, first of all, it's important in this class to understand what direction we're talking in. So for example, with the inflation model, I said, well, is that lecture about the impact of the exchange rate on inflation or the impact of inflation on exchange rates? Okay, so we need to be crystal clear about that. And this is about the impact of relative interest rates on the exchange rate. So for example, if say the 3-month T-bill in England was 3% and the 3-month T-bill in the US was say 4%, then how would you expect the exchange rate to be affected by that? And so that's our goal, the impact of relative interest rates on exchange rates. And like I said, this lecture is conceptually identical to the inflation model. The only difference is that the inflation model applied to stuff, like maybe this bottle of water, and this applies to financial securities. But I'll talk a little bit more about that in just a minute. So first of all, suppose the real rates, and just to remind you, what is a real rate? Well, when you go to a bank and the bank tells you, okay, well, we pay a 10% nominal rate. Do you remember what that was split into? Well, basically, it was split into two components. And so, for example, 4% of it, I'm just making up some numbers, might be expected inflation, and the other part was real. Okay. So, for example, you go to a bank and they say, hey, you give us $100 and you can expect to get 110 in a year, and so the stated or advertised or nominal rate would be 10%. And you can conceptually think of that 10% approximately as being, well, if hamburgers are expected to cost 4% more in a year than it is today, well, I should at least expect to be rewarded for inflation, right, or expected inflation. And then the other 6%, that's known as the real rate. You know, one way to think about what is the real rate? Well, the fact that you're giving your money to the bank, or depositing it, I should say, means that you're not doing work with that money. You're not consuming it, right? So you could think of the real rate as your reward for being willing to defer consumption. So the nominal rate is roughly equal to the real rate plus expected inflation. And if you want to be more exact about it, 1 plus the nominal rate is equal to 1 plus the real rate times 1 plus expected inflation. So in any case, imagine that real rates were higher in the US than in Europe. Then what kind of opportunity would there be? An arbitrage opportunity, right? And so everybody would want to invest in the US and so on and so forth, okay? And so when it comes to discussing this whole interest rate model, we're going to assume, similar to the inflation model, that prices adjust until there are no longer any arbitrage opportunities, and also no government intervention. So what that means is that we're essentially assuming that the real rate among countries are equal. So let's now relate the interest rate model a little bit more thoroughly to the inflation model, okay? So as I mentioned, the law of one price applied to stuff, okay? Like this pen. This pen should cost the same no matter what. So just to remind you, right here, the inflation model, here's a book, an identical book. We said should cost the same no matter what country you're in. And the exchange rate should be what makes it cost the same. Of course, if you recall, excluding what, you remember? Transaction costs and transportation costs. And an assumption built into this model, as I mentioned earlier, will prices adjust until there are no longer any arbitrage opportunities. So this is the inflation model. Well, imagine if, instead of the book, which is about stuff, imagine instead it is a piece of paper. In other words, it's a piece of paper that represents a contract that we call a financial security. For example, here's a piece of paper. I owe you, $10 in, say, 30 days. Okay, so I owe you $10 in 30 days. That's a piece of paper. That's a financial security. And of course, if it was the US government giving you that piece of paper, we'd call it a what? Call it a T-bill, right? And of course, the US government would have more credibility, and pieces of paper like this trade. People buy and sell them, okay? And so, whereas the inflation model is about stuff like this book, the interest rate model is about financial securities. But for the inflation model to hold, did the book have to be identical? Were you paying one price for obviously an identical item? You were, right? And so the interest rate model, would the same concept have to apply? Would the financial security have to be identical? It would, right? So basically, the interest rate model is about financial securities, and the price is the interest rate. So, why is the price the interest rate, you're saying? Well, I guess the best way to get this across is, or some intuition here, is when you go to a bank and you borrow money, and they say, all right, well, we're going to charge you 5%. Was that like a price? Was the bank providing you a service when they lent you money? They were, right? And that 5% is a price for the service in that they're lending you money. And of course, to them, if you're a higher risk, it's more of a service involved, so the interest rate goes up. But in any case, this is just like the inflation model. The financial instrument has to, of course, be identical, just like that book. It had to be the exact same book. And whereas we said with the inflation model that the exchange rate today was a ratio of what today? You remember? Well, if we go back one slide, okay, the exchange rate today is a ratio of prices today. So in other words, I should be able to take that $10 in the US that would buy this same book to Mexico and exchange it for 100 pesos, assuming the book is 100 pesos in Mexico. And so the exchange rate today is a ratio of prices today. The exchange rate, the expected exchange rate, is a ratio of expected prices. So if we go back to this, basically it's going to be very similar or identical conceptually to the interest rate model, basically a ratio of prices. But as I mentioned, of course, the financial security or instrument has to be identical. So in what ways can a financial security be identical? Let's take a loan, for example. Okay, let's say that you lend money to the US government. Okay, so what characteristics of that financial security? All right, I'll try to make it easier. You have a choice. You lend money to the US government or you lend money to the Japanese government. Okay, so in one case, obviously, you're lending dollars. In the other case, you're lending yen. In other words, we're talking about a US T-bill versus a Japanese yen T-bill. So in what ways can that financial security be identical? Well, what about risk, right? So if we applied the interest rate model to a Japanese versus US T-bill, what would we be assuming about the relative risk between the two? That they were the same or that they were different? That they were the same, right? So one way a financial security can be identical is risk. What are some other ways? Well, what about if it was a, say, 3-month US T-bill and a 6-month Japanese yen T-bill? Would that be identical? It wouldn't, right? So obviously, maturity has to be identical. What about how easy it is to trade this stuff at fair market value? In other words, how liquid it is. Would that have to be identical? It would, right? What about the two interest rates? Would those have to be identical? Well, actually, isn't the interest rate an outcome of all of these things? Risk, maturity, and liquidity? It is, right? So we're not talking about identical interest rates because the interest rate is the outcome of the various characteristics of the financial security. So we've got risk, we've got maturity, we've got liquidity. Maybe we can come up with some others, but the point is that if we're going to talk about this interest rate model and its impact on exchange rates, then of course we have to be talking about identical financial securities. And here's some characteristics in which they can be identical. So essentially, what is interest rate parity? Well, essentially, interest rate parity means that when you're thinking about investing, say Japanese yen 3-month T-bill or that US dollar T-bill, that the expected exchange rate at the time that you invest in should be such that you don't care whether you invest in the US T-bill or the Japanese yen T-bill. And the international Fisher effect says that the exchange rate should adjust over time such that that is true, or in other words, such that interest rate parity holds. So probably the easiest way to illustrate this is with an example. So let's do an example. So you are a corporate treasurer and you have $1,000 to invest for 180 days. And you've got some choices. You can either invest, say, in a 180-day US T-bill, and let's say that's yielding 3%, or you can invest in a 180-day Danish T-bill, and let's say that's yielding 8%. And imagine the exchange rate today is, say, 7 kronas to the dollar. And the question is, which do you choose? By the way, if you look at those rates, before we get into this, do you think that the dollar or the krona will appreciate? So here we have in the US, the interest rate's only 3%, and in Denmark, it's 8%. So based on that, would you expect the krona to appreciate or depreciate? Well, some of you are going to say appreciate, some of you are going to say depreciate, and I'll be honest with you. If I looked at this, my intuition would say, hey, you know, Danish T-bill, higher interest rate, yeah, I'd rather have the higher interest rate. And if that's the case, would I be converting my dollars into krona to lend krona to the Danish government? I would, right? In which case the krona would strengthen or weaken if people engaged in that activity. It would strengthen. And by the way, that's what I would have thought. That's what I would have voted if I'd been where you're sitting right now. But it turns out that's not going to be the case. Based on this, it turns out that the krona will be expecting to depreciate, and we'll see why. So let's get into this example. So let's say you invest in the US T-bill. So $1,000, 180 days, 3%. This is time value of money stuff. I'm not going to reteach it, and if you want to get solid with time value of money, you can look at, I think it's lecture 2 in my corporate finance series. But in any case, we're just taking the future value of this $1,000. Why do we take this 3% and divide it by 2? Well, it's just by convention. This 3% by convention is an annual number, and this is a 180-day T-bill. And so the only first step you can do with that 3% to turn it into an effective 6-month rate by convention or definition is to divide it by 2. And again, if you want to understand why, then you can look at the time value of money lecture. So let's look at the Danish investment now. So we know that the US investment grew to 1,015, right? So first of all, if I'm going to lend the Danish krona, and is that what a krona T-bill is? Is the Danish government borrowing krona? They are, right? So what's the first thing I need to do to my dollars to lend krona to the Danish government? I need to convert it, right? And so I got $1,000. The exchange rate today is 7 krona to the dollar. And so I end up with 7,000 krona. And so in the same way that we did on the previous slide, well, what does that grow into? Well, the future value of this 7,000 and 8 divided by 2 for the reasons we just went over. And so now I've got 7280 krona. So to see what I have in dollars, do I need to convert it back to dollars? I do, right? So I convert it back to dollars. So 7280 krona divided by the exchange rate, and I get $1,040. So if we look at what's going on here, based on that, my US investment would yield 1,015. My Danish investment, 1,040. Do you have a preference? You do, right? I mean, based on those numbers, you'd pick which investment? The Danish krona, right? Now, is that consistent or inconsistent with interest rate parity? It's inconsistent, right? Because we said that with interest rate parity, you would or you would not care about investing in the Danish T-bill or the US T-bill, assuming that they were identical in risk. That's an assumption. That they're identical in maturity, that's not an assumption because we know they're both 6 months. Identical in liquidity, that's an assumption. But the bottom line is that obviously we've done something wrong here, right? So what did we do wrong? Remember when we took that krona that we had in 6 months and we converted it back into dollars? What exchange rate did we use? We used the current exchange rate, right? And what exchange rate should we use? Well, we should be using, on day 0 when we enter into this, the market's expected exchange rate in 6 months. And by the way, does the market have an expectation of an exchange rate in 6 months? They do, right? I mean, the market has an expectation of a lot of things. I mean, you could take Apple stock. Why is Apple stock priced at, say, $500 a share today? Is it because of what's happened in the past or because of expectations of the future? Expectations of the future, right? I mean, if somebody buys Apple stock for $500 today, are they doing it in a direct sense because of what the previous guy got for it, who's selling it to, or because of what they hope to get out of it in the future? what they hope to get out of it in the future, right? I mean, the past is relevant in an indirect sense, right? You'll use the past to help you figure out expectations of the future, but in a direct sense, if you're buying Apple stock for $500 a share today, it's because of your expectations of the future. And so if the market has expectations of the future, which defines the price of Apple stock today, do you think it also has expectations of the future for exchange rates? Well, yeah. So basically, the flaw is that what we needed to do was this 72.80 that we had in 180 days, we need to divide that instead of by the current exchange rate at the time we enter into this investment. Instead, we need to divide it by the expected exchange rate. And that expected exchange rate should be what? What should this number be right here? Well, what was the outcome of the US investment? 1,015, right? And so if the outcome of the US T-bill was 1,015, and we don't care per interest rate parity whether we invest in the US T-bill or the Danish T-bill, then this answer right here should be how much? Also 1,015. And so therefore, for interest rate parity to hold, this guy right here, that's put that there as a plug, that is the expected exchange rate for the krona today in 6 months. So the market's saying today, hey, we expect that in 6 months, the exchange rate will be this 7.17 krona to the dollar. So that's basically the interest rate model, and obviously it's going to be convenient to put it in equation format. Okay. Now, if you recall, with the inflation model, we said the exchange rate today was a ratio of what today? A ratio of prices today, right? And we said that the expected exchange rate would be a ratio of what? A ratio of expected prices. And so, therefore, it's the same thing right here, right? The interest rate model, again, is going to be a ratio of prices. Getting back to that bank example that I brought up earlier, what did we call the price when you went to a bank and you borrowed money? We called it the interest rate, right? And if the bank says to you, hey, we're going to charge you a 5% rate, is that a nominal rate, or have they backed out inflation and it's a real rate? No, it's a nominal rate. So for a financial instrument, basically, the interest rate or the nominal rate or the interest rate represented as a nominal rate is the price. So here's the formula for the expected exchange rate. Does that not look identical to the inflation model? It does, right? I mean, the inflation model was E1, the expected exchange rate at time 1, is E0, the exchange rate today, times 1 plus expected inflation, divided by 1 plus expected inflation, which represented the expected prices. So we'll throw in the numbers in a minute just to clarify, that we've worked with. But again, same question as I had in Lecture 8. A lot of textbooks, they're going to want you to memorize, hey, what do I put on top? Do I put the US interest rate on top, or the krona interest rate on top, or whatever? Well, which one goes on top? Does the US go on top? Or does the krona go on top? Or does it depend? Well, it depends, right? I mean, if we're working in kronas per dollar, then what will go on top? Well, kronas per dollar, so kronas over dollars, so we'll have, the Danish interest rate on top. So if we plug in the numbers with our example, basically we'd get this guy right here. So here we have the krona interest rate, so the 8% divided by 2, etc., the US on the bottom, and there we get our expected exchange rate. So if we go back to the question, well, what happened to the krona? Did it appreciate or depreciate? So if you recall, krona had an 8% rate, the US had a 3% rate, and I told you, hey, just being totally honest, if I looked at that, I'd think, wow, people would rather have a higher rate, right? And so they'd want the krona, and so the krona would strengthen. But look, I'm wrong, right? Because here today's exchange rate is 7 kronas per dollar, and the market is saying today that they expect the exchange rate in 6 months to be about 7.2 kronas per dollar, meaning that it's expected to take more krona to buy a dollar or fewer kronas to buy a dollar. More, right? Which means in this example, the krona with the higher interest rate is expected to appreciate or depreciate. It's expected to depreciate. So why? What's the logic? Well, let's think about this. Getting back to the nominal rate and the real rate and so on and so forth. Okay, so here we know that both the 8% and the 3% are nominal rates, or do they already have inflation backed out? Well, they're both nominal rates, right? So here we have 8% nominal rate in Denmark, 3% nominal rate in the US. We know that these are split into what two components? Real and expected inflation, right? So real and expected inflation. Now, what did we assume about this whole model about real rates among countries? That they were the same or different? That they were the same, right? We assumed no government intervention and real rates were the same, which means that this difference, the fact that this is 8% higher in Denmark than in the US, means what? Well, if the real rates are the same, it means that Denmark has higher expected inflation. And so now, when you look at it from that perspective, hey, all right, yeah, krona's got a higher interest rate, but guess what? It's because of higher expected inflation. Now, would you expect the krona to appreciate or depreciate? You'd expect it to depreciate, right? So that is one perspective of the impact of relative interest rates on exchange rates. Okay, but here's another one. Okay, now we're going to violate some of the assumptions of this model. In real life, when the Federal Reserve, say in the US, announces, say, an unexpected US interest rate increase, how does the dollar react? So now we have the interest rate going up in the US. How does the dollar react? Well, it turns out it strengthens, which is kind of the opposite of what we've said here with the interest rate model, right? Because the krona with a higher interest rate was expected to depreciate, right? But the US, if the Fed announces, hey, we're going to raise interest rates by 0.5% or whatever it is, the dollar actually strengthens on the announcement. I'm not talking about the long-term impact, I'm talking about the announcement impact. So why? Well, let's think about this, okay? With the interest rate model, we said that obviously the financial securities are identical in characteristics, risk, maturity, liquidity, etc. Identical real rates and no government intervention. So what that means is when the Federal Reserve says, all right, well, I'm announcing a 0.5% increase, we have to ask ourselves, well, is that because it's a 0.5% real increase, with government intervention? Or did the market all of a sudden, in one split, and therefore 0% expected inflation? Or is it the other way around? Should this up here be 0 for the real rate, and the market all of a sudden increased their opinion of expected inflation by 0.5%? What do you think? Well, let's look at the inflation aspect. Okay, If the government did increase interest rates by 0.5%, ceteris paribus, what would that do to economic growth? Ceteris paribus, all else being equal. What would that do to economic growth? Would it make it grow even faster or slow it down? Well, if they raised interest rates, what would happen to the cost of capital? Go up, right? And if the cost of capital went up, then would it make it more likely or less likely that companies would build those new plants and hire those new employees? Make it less likely, right? So it'd slow down the economy. And I'm being very simplistic here, and I'm doing some hand waving, but just for the sake of getting across the intuition, if it slows down the economy and maybe they don't hire those new people and so on and so forth, does that mean, ceteris paribus, there's more money in people's pockets or less money? Probably less, right? Maybe some people have lost jobs and stuff like that. And if that's true, then does it make it easier or harder to raise prices? Harder, right? So if anything, when the Fed announces an unexpected interest rate increase, if anything, you'd expect inflation to go up or go down. Go down, right? And so basically, when the Fed announces a 0.5% rate increase, I'm not saying all of it, but at least based on how the markets react, it's dominated by, hey, this is government intervention, and it's mostly a real increase. And so now if I ask you, hey, would people rather earn a higher real rate or a lower real rate? They'd rather earn a higher real rate, right? And so if the federal government announced, hey, a 0.5% increase and it's real, would that attract inflows into the United States? Would people want to buy dollars to take advantage of it? They would, right? And therefore, based upon the announcement, you'd expect the dollar to weaken or strengthen. You'd expect it to strengthen. So in other words, if I just randomly took a vote and I say, hey, interest rate goes up or is higher in one country than another, ceteris paribus, would you expect to happen to its exchange rate? Would it strengthen? Would it weaken? Or do you not know? And the answer is you don't know. Because what you have to know is, well, is it higher because of a higher real rate? Or is it higher because of higher expected inflation? So I've told you all along that the interest rate model and the inflation model, that they're conceptually identical, which they are. I also want to show it to you mathematically. So if you recall the interest rate model, there's the equation for that. And we also know that from the previous lecture that the nominal rate is approximately real plus expected inflation, and there's the exact equation there, 1 plus the nominal equals 1 plus the real times 1 plus expected inflation. And so if I wanted to, could I substitute all of this up into here? I could, right? And guess what? I want to. So here it is. There's the substitution, right? And so we assumed that the real rate was what? Different or the same among countries with the interest rate model? Assumed it was the same, right? So if the real rate is the same, then do these cancel, 1 plus real? They do, right? And when they cancel, I'm left with the expected exchange rate is E0 times 1 plus expected inflation over 1 plus expected inflation. And that was the exact equation that we came up with the inflation model. And so this illustrates mathematically how they're one and the same, which makes sense. Conceptually, there's no difference whatsoever in the logic. And by the way, this is one of this interest rate model, this is one of the most empirically heavily supported theories or whatever that's out there. In other words, if you apply this to real life data, which you can, it holds beautifully. Because if it didn't, then what kind of opportunity would exist? An arbitrage opportunity, right? And this would hold even more than the inflation model. Why is that? Well, the inflation model, it depended upon transportation and transaction costs and putting stuff on ships and you know, taking the oil or the commodity or whatever where you can sell at higher pricing, all of that stuff going on, and it takes time and you know, still holds, you know, given the assumptions and the circumstances that we talked about. But with financial securities, at what speed can they move, if you will, across borders? Although what's relevant here is the exchange rate markets. At what speed can they move? The speed of light, right? So computers can pick up, you know, there's the slightest discrepancies between, you know, actual exchange rates and expected inflation and I mean interest rates, I should say, and so on and so forth. And so this holds very strongly empirically in the real world, the inflation model. So anyway, as always, if you're in my class, we would be looking at real world events, because there's always current events going on in the real world that can directly relate the theory of what we discussed and bridge it with practice. So if you're watching online and you're not in my class, I encourage you to do the same thing. And once again, we've achieved the goal of adding maybe one more cog of understanding of why the dollar goes up and down in value. And of course, we're trying to get an understanding of that risk, because we're going to look at managing this risk in future lectures. Anyway, I'm James Tompkins, and thank you for watching. I hope it was a good learning experience, and I hope to see you in future lectures. Take care.